73,000. So we do see a miss on this number, 73,000, the change in non-farm payrolls last month. That is lower than the 104,000 that was estimated. It's also lower than the prior read, which was 147,000, although we'll be looking for revisions here. The unemployment rate meeting estimates at 4.2%. That is versus the 4.1% that we saw in the month of June here. And then average hourly earnings rising in line with estimates 0.3%, which again is versus the 0.2% that had been estimated. Labor force participation rate was also an area that many economists were focusing on, that falling slightly to 62.2% from 62.3%. And there you see the year-over-year number for average hourly earnings as well, 3.9% versus the 3.8% estimated. So all of this equaling on balance, if you zero in on that non-farm payrolls number specifically, that coming in worse than had expected, and maybe confirming some of the concerns that we've heard from some economists about the underlying fundamentals within this jobs market here, that, even if some of the labor figures we've gotten recently have seen good on the surface, if you look beneath the surface, they have been seeing some signs for concern. If you look at the quick market reaction that we are seeing this morning initially to these numbers, sort of seeing the markets try and figure out what to make of this, but still seeing negativity expressed in the futures here this morning. Veronica, I want to start with you. Were you surprised here by this weaker number, and where do you think that weakness is coming from?
Yeah, this is definitely a weaker number. And I think actually it's not so much this July number, but massive downward revisions to the June number that we had last month. So initially that was 147,000 payrolls in June, just 14K after these revisions. So this definitely does look like a labor market that is weakening. The unemployment rate is, of course, the most important number here. And we did see that rise to 4.2%. That's still in the range that it's been in for the last year. But that happened despite the labor force participation rate falling more. This does look like a weakening labor market.
Leslie, does this change the calculus for the Federal Reserve?
We've always had the expectation that the Fed would cut in September. Obviously, after the FOMC meeting, that probability, the market was projecting a much lower probability that would occur, only down to about 40% and only about 33 basis points of cuts for 2025. I do think that number might shift that sort of rhetoric going forward, and we do anticipate still that the Fed starts to cut in September with consecutive cuts thereafter, leading to about 100 basis points of cuts in total. So I think that as mentioned, I think some of these revisions are much more than what people expected. I think if the revisions weren't so downward biased, you might have a different outcome. But again, when we look at some of these numbers, when it comes to the unemployment rate and inflation, we're really paying attention to the rate of change versus the absolute number. But I do think that this is a bit on the weaker side, and it does put cuts back on the table.
And those revisions that Leslie is mentioning, by the way, I want to tell people what they were, because if you look at the 2-month revision, it is a decrease of 258,000. So again, that, to your point, kind of shows that, yes, things were maybe a little weaker than they looked on the surface. Just to give you an example of what that means, it means what initially looked like 147,000 in June was actually only 14,000. So that is a big difference indeed. Steve, as you look at these numbers and you look at the market reaction here, obviously we were already down because of the trade headlines, which we'll talk more about in a moment. But now we're seeing, sort of that reaction at the very least persist here. How are you thinking about these numbers?
Well, Julie, the way I'm looking at them is, they're not good. There's no way to sugarcoat that. The 2-month revision is just staggering. It basically wipes out 2 months of what we thought were healthy job gains. So there were some comments this morning that from Bowman and Waller that was the reason why they dissented, was they thought the labor market was worse than it was portraying, and it seems that it actually might be. So what this is doing here, so you've got a real push-pull. On one sense, traders are just enamored with the idea of interest rate cuts, and this certainly has to raise the likelihood of cuts in the near term. It was about 40%, 45% for the September meeting. I haven't been able to get a fresh look now, but it's got to be way up, probably closer to 75 or so. But one of the things about rate cuts that I've always said is be careful what you wish for if you're a stock person, because sometimes the need for rate cuts is that the economy requires it, and ultimately stocks do better in a stronger economy than one that requires the intervention from the Fed. So there's going to be a push-pull today, and I think right now the push-pull isn't enough to move us away from the already negative tone that we were in, at least so far.
Well, and Veronica, speaking of the push-pull, you've got the, maybe, I don't know which is a push and which is a pull. You've got the weakening, what looks like a weakening labor market on the one hand. And then on the other hand, you have overnight President Trump announcing these tariff rates, what looks like is going to be an average tariff on goods coming to the U.S. of at least 15%. Some estimates would put it even higher, which in theory would at least cause a temporary upward pressure on inflation, which means the Fed is maybe in a tougher spot than ever.
Yeah, it's certainly not the ideal spot for the Fed, and I think we probably will see more, goods price increases. We just started to see that really in June. But if the labor market is weakening, then it really comes down to, do we think these tariff increases are going to lead to persistent inflation? Is it a supply shock like the pandemic? And that's where, if the labor market is weakening, it really isn't. You could see these temporary, one-time kind of price level resets in goods prices, but you wouldn't expect it to spread to services. We see wages slowing. Home prices have actually been falling on a monthly basis the last couple months. That underlying demand backdrop just looks very different.
Leslie, what does all of this mean for bond yields and for yields sort of across the curve?
It's really interesting because, as much as we look at this data and we say that the Fed should cut, but it wasn't that long ago what happened in, September 24 when they cut 50 and the back end actually rose just because of the concern over reacceleration of inflation. It's very important that the Fed doesn't cut too soon, simply because market perception will lead that back end higher, which obviously won't be good for the mortgage rate. I think this number is obviously weak. I don't think it really shifts the dynamic of the fact that the Fed will cut and they have a lot of ammunition to cut, but I don't think they're going to necessarily be that preemptive. I think this is one number you need to see, and we need to see the data because, be careful what you wish for, which is exactly right. It might not lead to the results that, one might think. And again, when we think about this inflation related in terms of tariffs, it's really going to depend. Is this going to be a really quick, price change that happens quickly over a few months and then falls, or is it just going to gradually rise higher, but then stay elevated above the Fed's projected target for a longer period of time? So they definitely have, a lot to deal with, but I don't think this one number necessarily changes the projection. But it doesn't necessarily mean that, cutting is going to assume that long-end interest rates are going to fall. You really have to wait and see how some of these inflation numbers due to these tariffs actually come out over the next couple months.
Yeah, a great point. And sort of another reminder: be careful what you wish for, be careful what you expect. Steve, we don't seem to be in the bad news is good news vibe this morning, right? Yes, you have futures bouncing off the lows a little bit, but they are still sharply lower here. So again, that it sort of makes one question the Fed galloping to the rescue narrative.
Well, I think the mood actually changed a little bit. I think the whammies of the tariffs and some of the earnings reactions, I think I would actually say we were almost in a situation where all news was good news for this market. And now I think there's been a reassessment. There's been a rejiggering of that. To Leslie's point, I'm seeing the 2 to 10 year yield curve steepening by about 7 basis points. That's a big move. I think right now, that's telling us some longer term worries about the relativity of inflation. Also, I just think right now, the market had sort of put tariffs in the rearview mirror and assumed that the labor market was okay. Well, both of those assumptions have been overturned quite dramatically this morning. And so I think this is the market going through a reckoning period. And I think it's a bit of a tell that we're not seeing a lot of reflexive dip buying, because that has characterized the stock market for the last, call it 2-3 months, where every dip was perceived as a buying opportunity. And as we saw them, what I would say the half-life of dips was getting so short because no one wanted to miss a buyable dip, so they were just stepping in at the smallest possible opportunity. We're actually seeing it persist for a little bit this morning. That to me tells me that the psychology, at least as of this particular moment, is a bit more tenuous than it was, let's say, even a couple days ago.
And Veronica, speaking of this sort of double whammy, I just want to ask you one more question about tariffs, which is what we learned overnight. Why was it such a surprise?
Yeah, I mean, I think it comes down to, we have been seeing these high rates, and we saw that announced in early April, but we've gotten them delayed, and maybe now we're not getting them delayed. In a lot of sense, some of these rates are not too dissimilar from what we saw announced on April 2nd. So there is some of this persistence to actually follow through with what's being announced. Of course, these are still starting maybe a week from now, so maybe there is still more chance to get them delayed, but there is more willingness on the administration to maybe follow through.